Where banks are silent, we speak. A podcast by You Mushroom.
Hello everyone, and welcome to our podcast series, What Your Bank Doesn't Tell You. Today, I have the huge privilege to speak to Paul Jackson, Global Head of Asset Allocation Research at Invesco. Welcome, Paul.
Thank you very much. It's great to be here.
It's a huge pleasure, given particularly what is happening in the capital markets. I'm sure we would cover a lot of very interesting topics. But before we start, I would gladly give you the opportunity to introduce yourself and to say some few words.
Well, so my job, as my job title suggests, I'm looking at asset allocation, advising investors, trying to navigate financial markets and economic and geopolitical developments. My background is as an economist. I was educated as an economist at the London School of Economics and Oxford, and I have spent most of my career doing financial market research at Morgan Stanley, Société Générale, and now at Invesco. So I've spent a lot of time doing this sort of research.
This is very inspiring, and I'm pretty sure that you're like an encyclopedia about the dynamics and the development of the markets. And you mentioned asset allocation, and particularly for our younger listeners who do the first experience with investing by buying a stock, or those days even buying a crypto. The concept of asset allocation is very foreign to most young investors. Why do you think asset allocation is important?
Well, I think, first of all, if you look at the correlations within assets, they're actually pretty high. And you find lower correlations across some assets. So I think the easiest way to get the biggest bang for your buck is by choosing across broad asset categories. And actually, if you look at the correlations and correlation matrices, the big decisions are probably how much to have in cash and when to have cash and not to have cash, and allocations to emerging markets. But overall, I think it just makes your life much easier and is more efficient to be allocating across assets rather than delving too deeply within the assets.
Yes, and I think an investor sleeps better overnight if you're well diversified, i.e. if we spread the risk across different asset categories. And I remember from my time in academia that there was a big discussion. What drives performance in a portfolio? Does it come from stock picking? Or does it come from strategic asset allocation? And the majority of the research, I would even say up to 90%, actually show proven long-term evidence that portfolio revenues are mainly generated long-term through asset allocation. So very interesting topic, and we are going to deep dive into it. Paul, given the current extremely high geopolitical risks, high tension with recently just coming to a little bit of a quiet moment, the tension in the Middle East, but who knows for how long, what would you say, what asset categories are expected to perform well in the coming months? And what asset categories are expected to be lagging given these tensions?
Okay. So I think the first thing that I would emphasize is that these sorts of geopolitical tensions, if you look historically, don't tend to have big long-term effects on markets. So I think it's very important to stick with your long-term goals and always keep that in mind. Don't get panicked. Don't be jumping in and out of markets or asset categories just because something has become a little bit volatile. One way to focus on the long term, funnily enough, is to be happy. Happiness makes us focus more on the long term. And so I think that should suit everybody. But right here and now, always remember when markets are going down and when they become volatile, there are certain risk premia that are recurring over time. So, for example, you tend to get higher returns over the long term on equities than you do on government bonds, for example. It's a very recurrent risk premium. Also, if you take a look at volatility in the markets, you tend to find that when volatility is very high, when you're at that really frightening moment in the markets, when all your instincts are telling you to get out, historically, those are usually the moments when you get the best returns looking over the next year. Now, I'm not trying to avoid the question. Looking at the coming
Very
months.
interesting. You actually already answered it in a very interesting way. Yes?
But looking at the coming months and the rest of this year, I think there are a number of things worth bearing in mind. We've had a lot of volatility, but things have calmed down. I think we're almost learning to live with the chaos.
Yes.
We're kind of dampening down the reactions to the chaos. Markets have recovered a lot, and stock markets have recovered a lot. Over the rest of this year, maybe over the next 12 to 18 months, I would expect the global economy actually to accelerate. Interest rates are coming down. Real wages are growing. The US economy is perhaps the weak spot, but globally, I think there's a chance of acceleration, which actually is better for riskier assets, for cyclical assets. So amongst asset categories that I look at, I favor non-US equities. So I think the US market is too expensive and the US economy is perhaps slowing down. So non-US equities, equity markets such as Europe. There's a lot going on in Europe at the moment, and China, which has been performing very well. But also asset categories such as industrial commodities.
That's interesting.
We've just seen energy go up a lot, and then it's come back down because of what was happening in the Middle East. But if the global economy accelerates, normally you would expect energy prices to go up and industrial metals prices to go up. And that's a very good diversifying asset category. And if you want to dampen the volatility, because as you said, you really want to have a balanced mix, you want to have some diversification, because we really don't know what's going to happen.
It is, yes.
And a good dampening asset category at the moment, it could be cash, which has got very little correlation with anything else. But the one that I choose at the moment is bank loans, leveraged loans. It's a short duration asset category with limited volatility. And at the moment, the current yield is very attractive. So a mix of assets such as bank loans, non-US equities, industrial commodities, and also REITs and sort of listed real estate, I think that gives you a good mix and a good exposure to an accelerating global economy, but with a little bit of balance in there as well.
So you would say that's very interesting and very insightful. What I learned is that take care of your happiness, because naturally you're kind of long-term oriented. Don't get into panic. I think one of the biggest mistakes, which we've also seen historically, is when people start selling in dips, because we as investors are very short-sighted. We forget that actually it's just a cycle. And typically after, as you say, typically after geopolitical shocks, the markets recover very quickly. They don't even react. In this case, we saw a little bit of a spike in the oil price, which literally lasted some few days, but the equity markets were not bothered. We are close to record highs in the US again. As you say, Europe is solid. And it's a very interesting insight to see that geopolitics should not really divert us from the long-term track of investing which we have chosen. I find also very interesting consideration to introduce leveraged bank loans. That could be done through ETFs and funds, for those of you who are not familiar with the asset category. And it's rather close to the cash, a fixed income proxy, if I may say so, because equities are the riskiest asset classes, or among the riskiest asset classes, but also with the highest upside performance, cash equivalents, conservative fixed income, secure reducing of the riskiness, i.e. of the volatility of a portfolio, give a good amount of a solid conservative a pickup over what we see on saving rates. With Switzerland, we know we don't have that. It's zero fees, zero interest rate environment again. As you say, Europe is reducing rates, and it's only a question of time probably that US starts cutting the interest rates. With respect to that, because we are now in the rate environment in the US, which is highly debated in the press and in politics. What do you think? Is it realistic that the Fed cuts twice this year?
Yeah, I think it is. And you bear in mind, the Fed has not reduced rates since December. Yes. Whilst most other central banks have continued cutting rates. So the Fed is kind of falling behind. And obviously the Fed has a real dilemma. which is that growth appears to be slowing down. We won't really know until the second half of the year because the threat of tariffs caused such a distortion in purchases and imports that the data is all over the place. But I think there is enough evidence to suggest that the US economy is slowing, and so that would encourage the Fed to cut rates. But on the other hand, the tariffs for the US give the risk of higher inflation.
Yes.
And this is why, this is the balancing act that the Fed is trying to perfect at the moment. But I think once they start cutting rates, once they have become comfortable that the boost to inflation is not going to be enormous, then once they start cutting rates, I suspect they'll go relatively quickly, partly because they've waited since December, and partly because next year there will be a new chairman of the Fed, and presumably it will be somebody who will be more aligned with Donald Trump's view of the world, which is that interest rates should be a lot lower than they are today. But I think for this year, yes, I think it is realistic that there could be 2 rate cuts.
It's, I think, also what the majority is expecting, and you argumented it very thoroughly. Why we are under pressure in the USA to cut rates, given where the global development is going. One asset category which we didn't mention in the strategic asset allocation, right? We said cash, bank loans are some kind of an enhanced cash equivalent / fixed income, conservative fixed income. We said European equities and global equities generally, China interesting, US rather slowing, but Europe still going strong, China going strong. We said industrial commodities. How about the traditional classical fixed income? Is that asset category interesting still to portion certain amount of my available capital as an investment in a long-term portfolio?
I would say yes. A few years ago, it was not, because rates were so low, and in Switzerland they are now. But if you look at the US on 10 to 30-year treasuries and the UK, you can get yields that are in the, let's say, the 4.25% to 5% range. And so I think that they have now become interesting again. Now there is a role for government bonds and investment grade credit within portfolios that perhaps 5 years ago the justification was lacking. So yes, I think it can play a role. I'm actually neutral on those asset categories at the moment. Although the yields have risen on government bonds, on US treasuries, say, I don't think they're particularly generous.
Yes, that's true. It's very tight.
So I'm neutral. So they do play a role in my model asset allocation, but it's not an asset category that I'm
passionate about and where you see huge potential.
Not passionate about.
Totally understandable, and particularly for Swiss-based investors, I think also it depends a lot on where the person is based. For Swiss-based investors, after fees of trading, very often actually there is nothing left if we are looking at fully hedged fixed income exposure. But as you say, in dollar or in pounds, where we still have some decent amount of a degree of interest rates or level of interest rates, we can actually really consider to put some kind of a neutral position. And you mentioned Gavi bonds and investment grade bonds. How about emerging market bonds?
Yes, well, I include emerging markets within those categories. And at the moment, within government bonds and investment grade, the two geographical areas that I emphasize are actually the UK, because the yields are that bit higher. And I don't think sterling will weaken in the way that I think the dollar could weaken over the coming year or two, and emerging markets. Yes. And so I still like it. I would say it's not as attractive as it was. The spreads have come down, but still, based on my projected returns, it is still an within fixed income. Emerging markets is a region that I emphasize.
Interesting, and thank you. That is also our observation, that effectively the yields also in this subcategory have come down a lot, the spread, particularly over the risk-free rate. We didn't talk about gold, and I'll be very curious to hear. we've seen a record after record this year. Gold is, I think, up 50% over 1 year's horizon. Are we going to see another 50% in the coming year? Or would you say, for the moment, we can expect a break in this accelerated performance of gold?
Gold is a really interesting asset category, and it has done so well. And everywhere I go, I get lots of questions about gold because it's done so well. And I think the prevailing view out there is positive, which itself is a bit of a cautionary signal. Mm-hmm. The way that I look at it is that if you were expecting US recession, then gold probably does well because Treasury yields come down, the TIPS yield, the real yield, the inflation-protected yield would come down, and the dollar would come down. And that's usually good for gold. Also, if you think that geopolitical volatility is going to stay with us or get even worse, then gold, as we have seen, tends to do quite well in those environments. I'm not expecting recession in the US. I think there'll be a bit of a slowdown. We'll get less growth than we had seen, but I don't think we'll have the recession. And on the geopolitical side, I think we've had a lot of volatility. We've had, first of all, when Donald Trump was elected the first time around in 2016, when he won that election, gold went to a premium to my econometric model because I think there was a concern about the geopolitical risks that could come from that. Then when Russia invaded Ukraine, another big boost.
It's a huge spike,
because of central bank buying by the Russian central bank, we think. And then when Hamas attacked Israel, there was another geopolitical boost that came in. So I think there's, and recently, interestingly, when Israel started attacking Iran, yes, gold went up, but it really didn't go up a great deal. And that suggests to me that there's maybe already a lot of bad news in the price. There's a lot of these risks that are already in there. So I maybe agree with what you suggested, that the second part of what you suggested, that yes, it's been fantastic. It's great if you've been holding it, but I'm cautious about the ability of this asset class to keep going. And I think there may be need for some settling down and consolidation at this stage, particularly because everybody that I meet seems to love the asset category at the moment.
Yes, it is the case, and it got very popular. And as you say, it actually, the price grows on bad news. And there is also this element that people started getting more and more used to bad news. And as you very nicely put in words, we seem to get used to live in very high uncertainty geopolitically. And given this degree of us getting that to a habit, probably we won't react that panic with such a panic and run to gold as a safe haven. I'm very curious to hear also from you, who are currently institutionally the biggest buyers of gold? What drives the demand? The production data is clear, but what drives the demand of gold what has driven the demand of gold over the past couple of years? Are those mainly central banks? How much is industry? How much are banks? How much is jewelry? That'd be very interesting to get some insights.
The big swing factor since 2022 has been central banks.
Okay.
It started with the Russian central bank, which bought, it's anonymous buying, but we think it was the Russian central bank that bought enormous quantities of gold in 2022 because they wanted to get away from the dollar-backed financial system. Mm. Since then, it is a much more diversified range of central banks that have been buying. The total purchases by central banks have come down a little bit, but still remain much higher than they were before 2022. But it's now a broader range of central banks, China, and usually it's central banks in the developing world that are doing the buying. Other than that, it was interesting that investors, if you look at the purchases of ETFs, the net purchases of gold ETFs or ETPs, they had been coming down for literally quarter by quarter for something like 2 or 3 years. And so I think that investors, for the most part, were seeing the price go up and that dissuaded them from buying. But last year, that actually changed. And we seem to change to a situation where the upward momentum then just became too compelling. And so investors started to jump onto the momentum. And so there has started to be small net inflows into those products, gold ETFs and ETPs. Otherwise, the purchase is spread across. There are industrial uses,
yes,
and, as you say, jewelry. But I would say that the big beast in the market has been central banks. But also, if you take a look at the net open interest position on gold futures exchanges, since Hamas attacked Israel, those net open interest positions have been very high, which suggests to me that there's a lot of activity going on in the background.
Yes.
Perhaps speculative activity about the way that gold could be impacted by geopolitical uncertainty.
Interesting, very, very interesting. And indeed, this behavior of central banks, particularly behavior of central banks from emerging countries, has been consistently going on. And as you say, it seems like they're replacing part of their reserves effectively with gold. That is also seem to be a very interesting trend there. Speaking of that, because we just touched the topic of currency risk in a portfolio, and you mentioned multiple times what's going to happen with the dollar over the past couple of months. What can we expect? Is the dollar exchange rate currently to the major counterpart currencies priced correctly? Is the credit risk of the US actually reflected correctly in the exchange rate? What is your view on that? Or can we expect downward or upward?
Okay, so it's a big topic and a very important topic.
Yes.
And I would say that for me, the dollar, if you look at real trade-weighted indices,
yes,
which is my way of valuing currencies, the dollar is expensive. It's about 20% above its historical norm against a basket of currencies adjusted for inflation differentials. So it gives you an idea of whether the US economy is competitive or not. And so the dollar looks as though it's overvalued. At the other extreme, looking across the most traded currencies, at the other extreme is the Japanese yen, which is nearly 40% below historical norms. And the difference between the two, of course, is that the Bank of Japan didn't increase interest rates in 2022 and 2023 when the Fed and literally all other central banks were tightening very aggressively. And if you look at the spread on US interest rates versus the other members of the 10 most traded currencies, the spread on US interest rates versus the other countries is historically high at the moment. And that's why the dollar has been strong. And likewise, the spread on Japanese interest rates versus counterparts is historically low. And so I think as the Fed does start cutting rates again, then I think there is potential for the dollar to come down. And as the BOJ incrementally raises rates, the yen will strengthen. So I think just for that reason, I think the dollar will weaken. But yes, there's a lot of things going on in the US. I think that let's say the volatility of policy in the US at the moment, and things like the tariff policies, what looks as though it will be a boost to the budget deficit from an already very high level, and the path of debt to GDP expected to rise even more steeply. I think those things potentially undermine the value of the dollar. And so international investors are now less likely to consider the dollar as their sort of so-called haven currency. And there has been this year, there looks as though there has been a bit of movement away from dollar-based assets. And I think that could continue to be a feature.
Be a trend, yes, very, very interesting. And as you say, indeed, there are two trends. There are two a little bit counterbalancing trends. On the one side, we see certain demand for U.S. assets still, particularly tech is under some institutional investors again a topic, and it seemed that certain amount of assets is actually flowing back again in equities, at least among institutional players. But generally, the trend is not as strong as it used to be, and we have concerns about Trump's tariff politics and how is that going to reflect the economy. You mentioned you expect a slowdown, not a recession. We also believe that there's going to be rather a slowdown, depending on but not a recession. And it's also a natural type of, how should we say, the American economy taking a breath and before they continue on the path of growth, I believe, given the technological advantage and scientific advantage which they have compared to the rest of the world still. But then again, of course, the big topic is how the next round of treasuries are going to be financed, who is going to buy that. And I wanted actually to ask you this question. We read in the press a lot that there are roughly 10 trillions, if I can pronounce the number correctly. It's an unimaginable number, 10 with 12 zeros on the back of it. Who are typical off-takers of US debt when it comes to refinancing? And do you think they will manage to place it successfully?
The first thing I would say is we are always worried about refinancing risk. If you go back over decades, there are always these there's this amount of refinancing that needs to be done, whether it's in the corporate debt market, whether it's in government debt markets. And it's very rare that it turns out to be a problem. But it's a bit like the triple witching in the equity market, in the options markets. Oh, it's triple witch. Nothing ever happens.
Yes.
So there will always, I'm very confident that the debt will get placed. Mm-hmm. And it's just a question of at what price and at what yield it gets placed. And if you're in a moment where there's a lot of pessimism about the US government and its debt, then the yield that has to be paid will be higher than it would otherwise. And maybe a month, 2 months ago, we had those sorts of jitters when 30-year yields went up quite a lot and CDS spreads rose. The cost of insuring against default went up. But those indicators have calmed down. So I think it will get done. Who typically buys it? Well, of course, a lot of it goes to the domestic investor base, whether it's individuals. And as we were saying, those yields are relatively attractive. So individuals, professional investors within the US, banks and insurance companies, they will be participating. The individuals
auctions
won't be buying in the auctions, but they are in the background providing the demand for the treasury market. And then overseas, you have a whole, literally every central bank and sovereign wealth fund probably holds US treasuries. And I think they will continue to do so, maybe less than they would have done in the past. And so there may be some this may be one way that some countries may express their displeasure with what's going on in the US and it's, for example, the tariff policies. Yes. But I think there will still be a broad range of demand from foreign investors. And who are the big buyers? The big buyers and the big investors in the US are those countries that run current account surpluses on an ongoing basis because they have capital that has to go overseas. And the US is usually a destination. So it's countries such as China, Japan, Switzerland, Germany. These are all countries that need to be putting money overseas all the time. And I think they will continue to do so. So the yield may be a bit higher than we've been used to seeing. It may not. But my belief is that it will get done.
Thank you so much. This is very, very interesting. And indeed, one of the concerns we've been reading always is like what would happen, particularly because China and Japan, I think, is the biggest holder of U.S. debt outside of the U.S., followed tightly by followed by China. And given the tension around tariffs, the question would be, is that going to be impacted? But you very well anticipated it and explained that maybe to an extent, but not really substantially. And the adjustment would go not through the volume be placed, but rather through the pricing, i.e. yields going potentially a little bit up, but no reason to worry. And indeed, I remember as well, each year it's a huge drama around refinancing of US debt, and actually never something happens. Like it always gets placed. It's only the question at what price. To cover one last topic, which I think is very interesting, and we kind of covered it indirectly, speaking about the fact that we expect that U.S. economy is going to slow down but not get into a recession. I believe we can kind of reverse conclude that most probably tariff talks would come to some kind of a reasonable, acceptable conclusion. What is your view on that?
Well, I certainly hope so.
Well, would you, yes.
If you, on my analysis, if you look at a world where the full reciprocal tariffs that were announced on the 2nd of April, plus the additional tariffs that were imposed on China that took their tariff rate up to 145%, plus the 50% tariff that was subsequently announced on the European Union. If you allow for all of that, in my opinion, US consumer prices would rise by 4 to 5% in the first instance, and GDP could be reduced by 3 to 4%. So there you're talking about recession in the US.
Yes.
The best possible outcome, in my opinion, is that we have 10% tariffs applied to every country and every product. And there you're looking at much smaller impact. Maybe the price impact is a bit less than 1%, and the GDP impact is maybe something like 0.6%. So those are the extremes, and we'll probably end up somewhere in the middle through a process of negotiation. We've seen just in the last day or so at the NATO summit, Donald Trump threatening Spain with double tariffs if they don't, because they're dragging their feet on military spending.
On the military spending, yes.
It'd be quite interesting to see how that could actually be implemented in the context of a country that could actually go via France. The goods could go via France or Portugal. It's hard to see how that would be implemented. But I think there will be a process of negotiation with partners. The UK has already got a deal on a part of its trade with the US. So I think that by hook or by crook, we will end up somewhere between the two extremes, probably with maybe a 10% tariff on most countries, perhaps 30% on China. There are still higher tariffs on some imports from Canada and Mexico that may remain in place, but we'll end up at a place where perhaps prices go up by 1 to 2% and where GDP gets impacted by about a percentage point. So that's the world that I'm thinking about, that I'm imagining will happen. There may be toings and froings in the meantime, but that, although it's not as good an economic outcome as we might have had in the absence of tariffs for the US, it is a darn sight better than the full reciprocal tariff regime.
That was very insightful. Thank you very much and super interesting. One last final word or message to our listeners out there, which you would like to share?
Don't worry, be happy.
Oh, that is a wonderful conclusion. On that note, thank you very much for being with us. Paul, big thank you for this super interesting, inspiring discussion.
Thank you.
Goodbye.
Where banks are silent, we speak. A podcast by You Mushroom.